So what is going on with bonds? Sure, they did rally today, but returns on bond funds and ETFs fell in May between 2 to 3% for most of them, and others tumbled by as much as 8%. So let's get some answers now from Robert Rowe. He's co-head of U.S. fixed income strategy at Citi. Robert, welcome. Good to have you with us. I think an awful lot of bond fund and ETF investors are very surprised. They don't know what to do. This is the kind of market they haven't seen in a long time. What are you telling them?
That's true, Tyler. I mean, I think that volatility has certainly picked up in the bond markets. I think since the beginning of May, we've had roughly a 50 or 60 basis point sell-off in 10-year rates. I think that, essentially, as far as we're concerned, that's not necessarily as a result of moderate economic growth, but also jitteriness on the part of investors thinking that perhaps the Fed tapering will not go as smoothly as the Fed probably expects. Right now we peaked at about 220. We have seen a little bit of a rally right now, but certainly we've reset to a higher rate level.
You know, Robert, so many people have said that we are in a new period in terms of how we look at bond investments versus stock investments. In the paper today, when I opened up, USA Today has a headline saying bond funds take a beating. The New York Times says bond investors think a Fed pullback is real. And then there was a report from Guggenheim Securities saying that treasuries are a Ponzi market. I mean, a lot of negative news out there about bonds, and yet investors still are holding onto their bonds. When do you see that big shift going to happen?
Well, I think we did see a bit of a shift at the end of the month in May and in the first week of June, when there was roughly about 10 or 11 billion of outflows in the taxable fixed income market, and that's not even including munis, which also saw some outflows. We didn't see the commensurate inflow into equities, for instance, which would suggest to me that most average investors are getting a little defensive, and that's probably warranted here. I mean, I think our forecast for the end of the year is roughly 2.5 to 260 on the 10-year, so we could certainly see rates rise a little more. I think that would be commensurate with probably a faster pace of economic growth than we've seen so far. And remember that usually seasonally we see a bit of a lull here. So I imagine that the market's repriced a little bit, but that it could stabilize from here at least until the fourth quarter of this year. I think investors should play the fixed income market a little bit defensively here, though.
Well, that's what I wanted to lead you to, Robert, and you're starting to go there. If you see interest rates on the 10-year bond at 2.5%, 2.6% at the end of the year, what does that translate to for someone with a 10-year duration in their bond portfolio in terms of principal loss, number one? And how do I take cover? If I want to avoid some of that loss, what should I be doing? What is the defensive strategy?
I think you could see another, if you're just talking about principal loss, you could see another % or 2 of losses on a market value basis. And certainly when yields are this low, that doesn't make for a very good total return. So at least within the context of the fixed income markets, I think shortening duration here probably makes sense. When you think about the fact that the market sort of priced an earlier move by the Fed, second half of 2014, we would probably think of that as a moderately low probability event. Then probably 2 or 3 year maturities right now probably present some value. Remember that the market, though, is extremely jittery about how the Fed may have an exit strategy, and that's also had a knock-on effect with credit spreads as well.
Well, we will hear more from the Fed next week, won't we, Robert? Thank you very much. Thank you very much for being with us. Robert is co-head of U.S. fixed income strategy at Citi.